So I'd like to, just to introduce this session, to say like blue natural capital is obviously vital in bringing, the funds and the recognition of what the ocean economy has to offer. It's not just, the kind of traditional marine natural capital that we talk about, like mangroves, seagrass, coral reefs. There's also untapped potential around seaweed, for example, kelp farms and so on. A lot of untraditional natural capital that we have. It's often undervalued. The health is deteriorating at a worrying rate. Speakers in this session, so we look at kind of, whether natural capital could be the missing piece, really, to conserve the ocean. They will also discuss how we can actually start to build the metrics around valuing natural capital. So I'd like to have the panelists join me on stage. So we have Marisa Drew. She is Chief Sustainability Officer at Standard Chartered. And we have Francisco Saraiva Gomez, Chief Investment Officer at Ocean 14 Capital. And great to have you. So Jan, please keep sending your great questions through the Slido. There have already been some really interesting conversations coming out of those questions. So obviously now we're talking about natural capital, but feel free to also build on the conversation that we just had around bankable projects and really kind of those collaborations that we need and the enabling environment. But this particular session will be focusing more on kind of why natural capital and why now, and what are the kind of tools that are emerging to value it, the standards that are emerging to make sure that natural capital has its place in the blue finance conversation, and the partnerships we need to build around that. So Marisa, I'd like to start with you. I mean, you are Standard Chartered's inaugural Chief Sustainability Officer after having led the sustainability strategy at Credit Suisse for a significant amount of time. So from the perspective of a commercial bank, why does natural capital matter at all, and why does it matter now in particular?
Sure, but do you mind if I go back to the question you asked your prior panelists a little bit, why SDG 14 is so underfunded in some respects? And the one thing I would say is that if you come at this from a traditional bank point of view, so that I represent the large-scale capital, part of the issue is that nobody owns the open seas. Physical on land, you have land rights, and those are bankable. Those are considered traditional assets, because this does lead into our conversation. And then when nobody owns it, and it's considered to be a public good, it's a very much more difficult thing to finance from pure traditional finance methodology. The other thing that we discovered in our work early on in the oceans was when we tried to pull the large institutional capital. So these are people running 10 billion worth of asset pools or more. We did get the question that I'm interested. If there was something available that spoke to my needs, I would be happy to invest. But what I'm missing is those structures that speak to me as an institutional investor. So then we set about working to try to break some of those hurdles down or deliver on that request. And I think the same type of thing, and I loved it, the gentleman who said we need to rethink, in some respects, how we finance. What does Finance 101 need to be these days? And I think now what we need to do is start to take this a step further and ask ourselves, how do we value those things that we are destroying, that if we protect them instead, the payback, so putting this into financial terms, the return on that conservation is many multiples of either inaction or doing something negative. And we see that now because we're living with it. Look at the destruction that's happening through climate events. But the problem is the system today does not price that in. And that is a little bit this kind of free public good or it's always going to be there tomorrow, so therefore I'll just keep on exhibiting the same behavior. So I think this is what we're going to talk about today, and this is why we're hard at work. But why now? Why now is because it's urgent. You've heard every single panelist has said it's urgent. The planet is screaming at us, telling us it's urgent. We're running out of our stores of natural capital. We're running out of fish. We're running out of the ability for the oceans to absorb the carbon that we see and need so much. We have these dead zones of the ocean where no life is able to exist that are the size, 500 of those that are the size of the UK. I mean, these are extraordinary statistics. So why now is because if we don't hurry up, we're going to lose all that we've got left.
Yeah, and in the previous panels, we heard that for some countries, there's already this kind of countdown, right, in terms of existential threats. But you also brought it back to the conversation we just had, which is great, which is, we need to redefine what finance is. And in a way, natural capital is, from the ocean, but also broadly, is a really good example for, the living economy. And the living economy offers all this return on investment that we haven't priced in, that we haven't valued yet, whereas it's the extracting economy that we have continued to kind of value, but it's starting to disappear, which means all that value will be lost as well. So that's a great point. And also, Francisco, I want to ask you as well. I mean, obviously, investing in nature is really at the heart of what you do at Ocean 14 Capital. So why has the time finally come for a better appreciation of natural capital?
Well, I think it's important to go back and to the basics. Natural capital started in the 60s, and it really got a win from forestry. And it was a means of accounting for hidden costs. Natural capital is what technically is called a transactional bargaining system to solve for the problem of externality. Mm-hmm. And the problem of externality is simply to understand. I own a business. That business has effects on things that I own. That's my day-to-day. But my business also has effects on things that I do not own, for which I'm not liable. And those effects go to the crux of the problem, because those effects are on public goods. And for those that are economists, the definition of a public good is also a non-transactable good. So how do you create a transactional bargaining system that is able to mediate all of the hidden costs of all the externalities that we create in order so that the externality becomes the internality? It's extraordinarily difficult, and focusing on the why is an important and meritorious step, because we need motivation to go over the hurdles. The first why is because it works. Wherever natural capital as a system has been applied, it has successfully mediated for transactions and values and costs that were not priced in the system. The second is because we need a whole lot more money in the oceans. I'm one of the 4 founding partners and the chief investment officer of Ocean 14 Capital. We're very proud to say that we're one of the largest ocean private equity funds in the world. We're very small. So that tells you a little bit of the problem. We're just 200 million euros. If the biggest fund is 200 million euros, how are we going to solve the capital needs of the ocean? And so natural capital for us is that. It's a technical solution to solve a real problem that we need to go faster. We need to solve the sustainability of the oceans, or else we're just going to do to the oceans what we did to land. And we need to capture more capital, and we need to give reasons for those investors to put money where otherwise they would not.
Mm-hmm. So yeah, you're definitely right, Francisco, in terms of highlighting it's a technical way of looking at it, but it's also a philosophical way of really looking at the ocean in a different way and really valuing it, in terms of how it should be valued. But in your experience at Ocean 14 Capital, I mean, what role do kind of the tools to actually measure these kind of values play? I mean, in terms of returns on investment, because you mentioned as well, Marisa, in terms of the return on investment is absolutely vital when you look at investors. So what is needed to better measure the ocean's value?
So there's $1.1 trillion in cryptocurrency in the world. Does anybody know how much carbon credit exists? What's the market cap today? It's about 865 billion. So there's more cryptocurrency in value than carbon credits in value. This, when I first found this out, it was puzzling to me. The carbon credit should represent a material, tangible benefit for society. It is liquid. You can buy it and sell it. The cryptocurrency has no material benefit other than it's a parity system ad hoc. There's more money in crypto than in carbon credits. Why is that? I think that speaks to the issues that we're facing today. Today, there are two bases two systems of natural capital. There's one that represents carbon credits. We call those transactional bargain systems, but they're actually top-down systems. They are more philanthropic than commercial. And then there are transactional bargain systems that are bottom-up, but those are done in clusters, in regions, and those are not well known. We think that in order for carbon credits, blue credits, whatever natural capital security we can create to scale up, it needs to solve what we call the Big Mac of natural capital: monetization, arbitrage, and convergence. And those three things that are technical issues that are in earnest are things that actually prevent us of going faster. Let's start from the end, from the beginning, from the end. Convergence. Convergence is about unveiling ways how the externality is just a time fallacy. With enough time, any externality is going to kill my business. So convergence is really a way of tying the externality of the business to the ownership of the business. If you are a fish farmer, and if you put too much fish in one fjord, there will be an effect on your business 5 years from then. That's real convergence. You may choose to ignore that during the 5 years where there is no material effect, but 5 years later or sometime later, that externality will become an internality. So the first thing that we try to do at Ocean 14 in our businesses is to unveil this real property of risk, the real ownership of liability. If it comes back to me 5, 10 years from now, then it's something I should consider. If it comes to me 20, 50 years from now that's a different problem. Now that has different solutions. But the beauty of the oceans is that water is such this wonderful equalizing element. Fish, animals, they breathe, they excrete, they eat, they drink, all in water. It's a great accelerator. So externalities in the ocean economy are on average shorter time span than inland. It's faster for us to detect them. And so it's easier for us to go to our wonderful tilapia farming company in Brazil and show them how they are completely linked to the natural capital that they're consuming. And if that relationship somehow is not unveiled, is not isolated, and it's cared for, their business is going to go out of whack. Mm-hmm. So that's the first thing we do at Ocean 14 is removing the fallacy of externality. If we're using the resources and we're consuming this public good, even if the effect of public good on others is not visible, we need to find a way of making it tied to the dollars of the company's balance sheet and income statement. Others have done this top-down, carbon credits, LCA, metrics, parameters. Because we believe that arbitrage is so important, and I'm speaking so much, I'm sorry. Because we think arbitrage is so important, and us being financiers, we'd like to own that arbitrage. So it has to be transparent. So for each company, we create bespoke measurement systems that actually measure the environmental resources together with the financial resources. Mm-hmm. So when you look at Ocean 14 investment case, our economic case and our base case and our impact case comes from the same operating case of the business. So we develop this convergence so as to measure it and care for it quickly. The third element, monetization, is much more complex, but let me stop here. Mm-hmm.
Well, I'd actually add one more, which is you've got to create confidence, right? Because the markets today don't have confidence actually in the impact that's actually being created by those dollars being put to work. We're facing a moment right now where there has been questions about the credit markets, period. And we can have a debate all day long about whether the science behind those accusations was right, not right. It has created a crisis of confidence in the carbon credit markets. And if that confidence doesn't get restored, people aren't going to use it. And look what's happening to the crypto market, right? It's eroding exactly right. enormously quickly because everyone's lost confidence. Yeah. So, and one of the ways to do that, and you heard that on some of the prior panels, is to actually have a common set of operating principles, an understanding. And I come from, building large asset classes. And when you start to see capital scale, it is when there's a common adopted set of principles and ways of operating that provide that confidence. And each individual investor doesn't have to go and do the work you're talking about. This is hard graft. This is extraordinarily hard. Big pools of capital are saying, make it easy for me, right? What does good look like? Give me the gold stamp of approval, and the capital will follow that. But this is the spade work that we've got to do right now in our space.
Yeah. It's so interesting to hear you because it really reflects how far back we are. So I said arbitrage, Marisa said trust. For anyone that works in financial industry, arbitrage is what happens once you have a trustworthy system. Yeah. And so that's so true what you just said.
Well, look at the bid-ask, by the way, on carbon prices. You have $2 to $75. That is the spread in kind of what I'd say the quasi-functioning carbon markets today. That just tells you something right there that the market's not yet functioning appropriately and properly. You shouldn't have that big a spread.
And it's a huge opportunity, as you said, with the confidence. I mean, we had this kind of shock in a way, this kind of revelation that carbon credits are not really working. But with any of those kind of crises, it's actually an opportunity. And we heard about the high quality blue carbon credits being created because they have all these co-benefits, in terms of community engagement, in terms of creating these kind of additional benefits from, there's of course carbon capture, but they're also great for biodiversity. They're great for cleaning up the ocean. And telling that story and making that case will then also instill confidence. And then, of course, you need regulatory framework and the standards.
That's right. And that's a really good point, the other thing that we need are more proof points. So the more that we can demonstrate that these things are happening, it's that classic story of overfishing, right? That is the MPA story that we've been telling for a while, is if you just leave this space alone, the fish stocks come back bigger and more robust and healthier. So that time duration that you talk about, which is really quick, then allows us to observe that instead of selling the fishing rights to the bad guys that blast fish and do all this, if you're actually managing sustainable, you'll keep that going on and on and on and on and on, and you've got livelihoods for the people in those countries and all the other stuff. So, but we need more of those kinds of case studies as well that give governments confidence that it is better, right? We say better worth more than alive than dead. It's that same kind of a concept, right? You need the governments to have that confidence because they're elected political leaders. They're the ones selling those licenses. So you need to prove that it works, and it's also good for the people in the communities. So that's just one small example, but there are, all the examples, I think, of where you're investing. We're going to have more of those proof points that show the impact that you deliver by doing it the right way, and that those paybacks are really there. Then the investment community will follow.
Yeah, that makes sense. Those proof points, and I mean, Francisco, do you have one of those kind of examples? Obviously, you are very much focused on aquaculture, and you have an aquaculture background as well, right? So, do you have examples of where that has really happened in terms of creating those kind of examples and case studies of climate, biodiversity, pollution, tackling these kind of integrated problems?
Well, we don't work that way. So what we're trying to do is, because we do see an enormous market opportunity on the technical issue of arbitrage and net cap, we're actually we're looking at this as a business opportunity. And so for us, it's very important that we bring to people like Marissa this fundamental gap that they have, which is, how do I correlate this with that correlation of environmental gain with economic gain? And today, this conversation is completely impaired. We are all here in the room because we believe that there is a natural positive outcome to that conversation, but none of us can point to that outcome, right? We're trying to create the metrics. So in each company, we develop a bespoke metric system based on the theory of change and based on the underlying exploitation of resources. For SciAqua, which is a shrimp breeding company, our theory of change is that over time, their aggregate customer base will become more efficient because their genetics are better, and therefore they will consume less land, less water. We should be able to make that measurement, as simple as that. That mechanism seems simple. It took us 6 months to isolate it in a way that we could be comfortable with setting up a metric system that could yield some kind of arbitrage. But that doesn't answer my other question. Why should I put money in that company versus my clam breeding company in Italy? Now, that's a smaller business. One was a double-digit investment. The other one was a single-digit investment. It's breeding. It's animals. It's in water. In terms of net cap, where do I make more net cap? Where is my return on net cap greater? I don't know the answer to that question. And the only way that we can is to build bottom-up. So on every single company, we are building its own carbon credit system, or its own verification system, its own independent arbitrage system. So that hopefully, 10 years from now, I can show to people like Marissa, it's better to invest here or there.
And what I'm trying to do is, and that is wonderful work and necessary work, but that's a 10-year exercise. And when I think about the fact that we've got our 85 months left in the Maldives, we also need to, I hope, not hold ourselves back from allowing and at least theoretically getting that capital to be put behind what we, I think, intuitively know is the right answer, but we can't yet prove it on a technical level. So maybe a good example is just general conservation finance. That is actually taking a bet that investing in nature is going to yield better payoffs. A good example that has gotten a lot of publicity is one of my darling transactions, which was the debt for nature swap in Belize. And the concept behind that was that the investors were prepared to help restructure the debts of this country on the condition that a portion of those proceeds would be put into an endowment, and that endowment, administered in a very careful way by a wonderful conservation organization, would focus on making sure those beaches were clean, making sure that fishing was sustainable. And the theory behind that, without having all the technical answers, was that actually if you do that, you're going to create livelihoods for the people, you're going to create a Caribbean island that everybody wants to go to, all the ecotourism, and it's going to be a wonderful net benefit in addition to having a capital stack that the country could afford. So that was an interesting example of capital jumped in with the idea that this was going to be good for everybody, and you had a progressive government, a progressive MDB, an underwriter such as ourselves, and a conservation organization that said, we've got boots on the ground, we know how to do this in the right way. And that was kind of a beautiful expression of, we're almost not yet there to the technical, but we're ready to back that one.
Exactly. And designing projects like that, with having those different stakeholders involved, the technical capacity building, as well as conservation finance experts and the people that put the money behind it, not necessarily having all of the metrics ready, but knowing intuitively that it's going to have this impact. That's also what has to happen in addition.
And synergizing, because it's really not one or the other. It has to come forced, and it has to be built emergently. So this is the most important conversation in NetCap today, I think.
Agreed.
Is that collaboration?
And I don't want to leave blue carbon yet, really, because there's an important piece to blue carbon when we talk about it being a high-quality credit. One of the challenges that we have, of course, as necessary and important and as good as it can be with tree planting campaigns, how long does it take to grow a forest of trees? And the maintenance factor of someone administering to make sure that those trees continue to get the right water and the right everything so they continue to grow and sequester carbon, that's a big lift. And that's a 100-year lift if you're, hopefully if these carbon credits, which are the high-quality ones that everybody wants, are going to do their job. Oceans, actually, you create a healthy ocean, it does that work for you into perpetuity. And that's kind of a provocative area that is underexploited and underexplored. So in a funny way, when we're starting, I think you made the point that maybe this is a moment for us to actually think about, in this wobble that we're having in the credit markets, maybe non-terrestrial credits, it's our day to describe what that could possibly be if we do it right. So I'm excited about that from a
I cannot resist. If natural capital, as we think of it, exists and can be monetized, the largest pool of it is in the oceans. Because natural capital can be defined as all the sum of all the benefits that are extracted from an ecosystem that is not owned. What is the largest ecosystem on planet Earth? The oceans.
Exactly. Great final words. Thank you so much, Francisco, and also Marisa, for highlighting the importance of natural capital. You mentioned how important it is to have that confidence. You mentioned the Big Mac. The Economist produces also a Big Mac index, so it's great. I mean, this is not a case for Big Macs, but there's just another Big Mac, monetization, arbitrage, and convergence. So having that technical metrics approach, as well as the intuitive approach of conservation finance, for example, can work hand in hand. Thank you again.
Thank you. Thank you, Maria.